Hey guys, Chris from Empower here. So last night, the federal government handed down their 2023 budget. So I want to give you a quick rundown of the things that apply just to business. So they had a fair bit in the budget, but I just want to talk about what is installed just for business alone. So the bad news is it's all bad news. There's no wins in here at all for small business at all. So let's jump into it. First thing is the low middle income tax offset. So this is something that was introduced a couple of years ago. So basically it's now gone. It wasn't part of the budget, but they didn't announce anything about it, but it is actually gone. They haven't extended it. So what was it? So if your income was between 48 and 90 grand per year, you got an extra $1,500 on your tax return, basically an extra in tax refund when you lodge your return. So you could have incomes either side of that and sort of taper off that amount from there. But basically, in your tax rate, if you're an employee this year, $1,500 less is going to be in your pocket in your refund this year. So if you got, say, 2 grand last year, expect to get about 500 this year. So for small business, it just basically means, as you know, you pay tax along the way. It means you have an extra $1,500 worth of tax to pay if you're in that tax bracket from there. So the bad news for this is actually, so if you're a husband and wife on about 80 grand each, that's $3,000 gone compared to last year. So obviously it's going to cost a bit of cash, and if you put that into perspective, if you got a $600,000 loan, that equates for mum and dad in that sort of income, that's about 0.5% on your, as a bit of an interest rate rise effectively from there. So yeah, less cash for individuals. Next one, so this is the big one, instant asset write-off. So in the past, businesses could basically write off an asset on tax straight up and get big tax deductions, which was great. What the rules are now, if your turnover is over 10 million, that limit reduces to 1,000. So huge there. So if you're over 10 mil, $1,000 is a limit to write off. If you're under 10 mil turnover, it's $20,000. So obviously a huge reduction there. The big one is obviously buying cars. So how does this work in practical terms? Just giving a quick example over here. So if you trade in a car, which is a pretty common example, if the car is worth, say, 50 grand and the one you're trading in is worth about 30, what's going to happen now is, under the old rules, you would effectively get a $20,000 tax deduction because of you're purchasing something for 50, getting the deduction, selling it for 30, and that is income. Purely because of the previous car was written off for tax, so when you sell it, you pay tax on the whole sale. But obviously you're getting the deduction there, so you get effectively a $20,000 tax deduction. Under the new rules, you still have to pay tax on the $30,000 trade-in, but on the purchase of that $50,000 car, you don't get a $50,000 deduction anymore, you get a $7,500 deduction. So effectively, you have $22,500 that you're paying income tax on. So previously, you were getting a $20,000 deduction, but now you're paying $22,500 as income. So in terms of tax, so if you're on a 34.5% tax rate, effectively these sort of rates here, now up to 120,000, 34.5%, that's $7,762 of tax you have to pay. So as a small business, if you trade in a car, new car for 50, trading the other one for 30, so effectively no cash is really changing hands. You're either throwing in 20 grand cash to buy the new one or getting a loan. It's going to cost you nearly $7,800 in tax to upgrade your car. So something to be very mindful of there. And if you're unsure about trading in post 1 July, let us know and we can let you know what the tax implications would be for you if you were to do that. So obviously advice from there, if you were thinking about getting a new car or equipment or just assets in general, it is worthwhile looking at getting it prior to 30 June to get the write-off in this year. But again, I would only do that if you were looking to buy assets in the short-term future, because there's no point in buying assets for the sake of tax deduction. So the next one is the SGC, so super, employee super. So you'll now pay the employee's super on the same day that you do the pay, but that won't come until 1 July 2026. So still 3 years away, yet plenty of time on that. The last thing that they announced was the ATO audit activity. A bit of an interesting one here. So they've announced there's going to be $89 million for income tax, basically audits and reviews over the next 2 years. And in particular, they're focusing on rental properties. So the big one there they're looking for is actually the interest on the loans, to make sure that you weren't redrawing on loans, the rental property loans in the short term after getting the loan, or was the initial loan set up for that purchase of the rental property, because obviously interest is a big deduction for them, and they're actually getting that information direct from the banks as well. So that's how they're doing their reviews. They're getting the information from the banks direct and making sure that the loan, that money was used for the purchase of the rental property initially. So next one, $40 million on super guarantee. So that is over 1 year. So that's just the next year. So I would probably, given that we're going to have the same day super pay from 1 July 2026, I would almost expect that amount to increase as the years go on, because it is such a big area of audit for the ATO, and obviously making sure that employees are getting paid on time. So business owners, probably, very important that you pay your super on time in that one, because effectively the ATO are coming. They're getting more and more data on this now. The last one is $588 million of GST audits over 4 years. So effectively GST audits are clearly a big one for the ATO. That's where they also get a lot of money from there. So no real surprises, but as you can see, the amount of money they are spending on ATO reviews and audits is huge. So it's very important to get these things right to stay out of the ATO's crosshairs. So any questions on any of this stuff, feel free to let me know. Thanks guys.